Hello and welcome back to Online Learning for Economics. We got a couple weeks left of this format of learning this year at least, and so we're going to wrap up the year talking about the stock market. Now, the stock market is something that whether you engage in it or not does have an influence on your daily lives. Think about coronavirus right now. If you're watching the news, they're constantly looking at the market, which they mean the stock market, and how different stocks and companies are doing and determining how the overall economy is doing based off of that. Now, traditionally, if we were in the classroom, we had a whole game. You would invest in the market. You would try to maximize your earnings. There'd be people who won because they made a lot of money, people who lost because they lost some money, and it was a really good real-world example. Unfortunately, we just don't have the time or resources to do that right now, but you should walk away with a pretty good understanding of how stocks work. And hopefully when you get out in the real world, if you go to secondary education, you'll take some sort of personal finance course or economics, and you'll really dive into that. So we're going to split this into two separate days and activities. Today I'm going to introduce what stocks are and introduce what they look like. And then next week, we'll do a brief trading activity so you can get some experience with it. And then that'll be it for Econ 2020. So, the stock market. First, what is a stock? Okay, well, a stock is actually, really simply put, the shares of ownership in a company. So if you think all the way back to our third unit when we did the different business models, one of those business types was a corporation. Corporations don't really go to banks for loans to start their companies. They sell shares of ownership called stock to raise money. So in exchange for 1%, 2% of the ownership in the company, they get money to actually start running the company. And as they grow and succeed and expand, they're able to sell more and more stock, and it's used as a way to raise revenue. So stockholders or shareholders are used interchangeably to talk about the people who own shares of company own shares of stock in a company. Okay, that's about as simply put as it gets. Now, there are two types of stock you could buy if you wanted to invest in a company or you wanted to buy shares of that company. Those are common stock and preferred stock. Now, common stock is the most common type. It's what you're probably going to buy if you log online or you call a stockbroker and you want to start investing in the stock market. So, with common stock, what you do is you get a share of the company and you get a share of the voting rights in that company. So you get to be a part of the decision-making process. Now, in a smaller company, you may have put up 25, 30, maybe 50% of the capital to get started. So you have that much of a say in what goes on in the company. Now, in very large companies like Fortune 500 companies, so we're talking about Amazon, we're talking, Facebook, Walmart, Target, there are thousands and thousands of stockholders. Well, every decision that needs to be made cannot be left up to thousands and thousands of people. So what you do then in those instances is you vote for a board of directors who serve on your behalf and make decisions for the company that best benefit you. Now, we're going to talk about how your benefits come into play in just a minute, but that's what common stock is. Now, preferred stock operates a little differently. You can buy preferred stock in a company. Now, you give up all of your voting rights, meaning you give up any say in how that company does its business. But in the case that the company maybe starts to fail or declares bankruptcy, what they do is liquidate. They sell off everything. They take as much money as they can that they get to keep, and they divide it up among its owners based on their shares. Preferred stock gets paid out first in that case. So when you buy preferred stock, you are guaranteed first dibs on the money after a company closes to get some, if not all, of your money back before the common stockholders. But in exchange, you give up your voting rights. Hope that made sense. I'll be live after you go through this to answer any questions. But those are the two different types of stock that you can buy. So why would you buy stock other than maybe believing in a company and what they were doing? Well, there is a reward to this. You can gain a few different ways. One, most stocks are designed to be long-term investments, meaning you buy a few shares of stock in a company, and then in 30 years, if that company does well, it gets better, it gets bigger, the value of your stock goes up. And eventually, you can sell your stock at a price much higher than what you bought it for, and you get to keep all those profits on your own. Another way to make money, although not as much, are through dividends. Some companies, in an effort to entice people to buy stock in their company, actually give out a share of their profit to all of their shareholders. These are called dividends. So usually paid out quarterly, once every 3 months. Depending on how much stock you own in a company, you get a small share of that company in a dividend check. Now, this is going to be small. I mean, these are pennies on the dollar, if that even. So unless you own a lot of stock or in a very, very big and profitable company, I mean, you're not going to make a living off of dividends. But it's a way for companies to kind of keep the faith with their stockholders that they're doing well and to encourage people to buy. A company doesn't have to pay dividends. It's up to them if they want to. And then finally, the last way to make money in the riskiest way, and next week we're going to talk about risk before we dive into making trades, is called trading. Some people actually make money on their stock market through regular trading of stocks. And basically what that is maybe you've heard the phrase buy low, sell high before. What people do is they look at the stock market, they look at trends, they look at companies. They buy a lot of stock when a company has a very low price per share, and then they wait a little bit, and if the company's stock goes up in price, they sell it for an immediate profit that they roll back into other stocks. Now, if you're good at this, it is a way to really increase your overall capital, increase your overall assets very, very quickly. However, it is just like gambling in the fact that not that many people are that good at it. So your average person can't just go in and start making trades on the stock market and get a lot of money. Speculation plays a big piece in it, guessing how certain stocks are going to do. And the speculators, the really good ones, are the ones who make a lot of money. It's going to take a lot of schooling, a lot of research, a lot of practice. I would not suggest that when you turn 18, you take your graduation money and start speculating or trading on the market. You're probably, best case scenario, you might break even, but you're probably going to lose out on some money in that case. Okay, so this is what we're going to do today. We're going to familiarize ourselves with stocks and what they look like, so that way next week we can trade. So, below the video on the Google Classroom post, I've posted a worksheet. And what it has is it talks about a stock ticker. And a stock ticker is that short little snapshot of all the financial information you need to know about a company before you invest in that. It's what you see if you go to a website like Yahoo Finance or E-Trade, or if you pull up like CNBC, Moneyline, different shows on TV. So read through all the different pieces of a ticker, look at the ticker examples that are given to you, and see if you can answer the questions finding the different pieces. And then next week we'll use those ticker examples to make some trades of our own. They're fictional trades. It's a simulation, but it should familiarize yourselves with the stock market. Okay, so if you have questions, I'll be live. This is economics, so 9 to 9:45. I can clear things up. We can walk through some stuff together. Other than that, you can always email me questions. Work through that sheet, and next week we'll simulate, make some trades, and wrap up for the year. Thanks, guys.